All right, welcome everyone to today's session, financing your deal. So week four, we've gone through mindset. We've talked about the different strategies with investing, looking at both residential, commercial properties, and diving into the different strategies that you can kind of integrate into your investing strategy, business plan. And tonight we're going to be talking about financing. One of the I would say most critical parts of the deal, because it does no good to get a deal under contract and not be in a position where you can close. But also, I love the financing aspect of the deals just because the creativity that you can bring into it. And so we'll talk a little bit about that as we get going tonight with financing the deals. But we're going to really go down two separate tracks. So number one being traditional financing options that most of you have definitely heard at some point, if you've been around real estate at all. And then also some creative financing strategies that you can leverage in regards to, maybe looking at different funds, raising private money, self-directed IRAs. Some of those are examples that we're going to dive into that you can leverage for your real estate deals here in the future. For those who I haven't met and had the opportunity, Johnny Lynham, and really super passionate about real estate investing, husband, father, soon to be retired lieutenant colonel from the Air Force. Been investing in real estate since 2006 and built a considerable size portfolio over the years and just continue to grow real estate and helping others change their lives through real estate is what we're about with REI Genius and our mission, and just being out here and as they say, belly to belly, having conversations and helping people realize their potential when it comes to building wealth with real estate. One of the big things that, kind of going through that, if you found your ideal and perfect property tomorrow, would you know exactly how to finance it? And, this is a really, really important question because, when we start talking about the marketing, that we already looked at the different strategies that are out there that we can implement, but how do we get the deal across the finish line is extremely important. And having those funding sources laid up and ready to go before you find the deal are extremely important, because as you're going through the due diligence, the last thing you need to be worried about and struggling through is how to identify the right financing. And so building those relationships on the front end, whether it's private investors, whether it's traditional banks, lenders, mortgage brokers, having those relationships up front before you need them is extremely critical to long-term success as a real estate investor. This guy here, Tony Robbins, knows a thing or two when it comes to investing. For those that haven't picked up his book, I think it was released February 2024. The Holy Grail of Investing was an extremely well-written book. And it talks about investing. There's some creative financing when you start talking about alternative investment in funds, but also some other non-traditional ways of investing, where his thesis is all about finding uncorrelated investment, at least 7 uncorrelated investments that you can invest in and diversify your portfolio in order to be successful long-term. But at the end of the day, it's not about having resources. It's about being resourceful. And when it comes to success, Tony Robbins talks about it, that 80% of success is your mindset and 20% is skill set. And it's no different with, when you're just going into the focus area of financing, that you have to be resourceful. You have to be creative. You have to think outside the box. How do we get to yes? And always understanding that the glass is half full versus half empty. And being resourceful is one of those key tenets of being able to have problem-solving skills. One of the things that we definitely tout in the military is being able to be flexible in our approach and having. All right. One of the things that we always say in the Air Force is flexibility is the key to air power. And having that flexibility in your approach, and especially when it comes to financing your deals, is going to give you greater opportunity to get more deals closed at the end of the day. And why it matters, it's all about leverage. Real estate is the ultimate asset class where you can bring in leverage to grow your wealth. And, one of the things that I always look at with when I'm talking with veterans and looking at leveraging the VA loan, and a lot of times, depending on the circumstances financially, some individuals are in a position where they can actually put 5% down and avoid having to pay the VA funding fee completely, which depending on the circumstances. But the thing that I love, and we talk about here in the Washington, D.C. area where I'm based out of, is just over the last 60 years that real estate has appreciated on average a little bit over 3.5% per year over the last 60 years. And so with that, one of the great things with the market that people realize is that you have the opportunity to grow your wealth based off the appreciation of the home price and not your down payment. And so if you're buying a $900,000 house and you're putting down 45,000 or 5%, then now your wealth is growing off that appreciation off that $900,000 home value and not the $45,000 down payment. And that's the power of leverage, where with 10 years, 3.5%, now you've grown 35% increase on that $900,000 home and not 35% on just the money you put down, that $45,000 down payment. Or in some cases, if you pay the funding fee, then guess what? 100% where you don't have any money down. Maybe you just paid closing costs. Real estate is all about leveraging your resources to grow your wealth at the end of the day. So diving into different funding sources, and I talked about a little bit up front that when we start talking about the traditional sources, but then also those creative sources that are a little bit non-traditional that allow you to get deals done. And so at the end of the day, when it comes to it, that it's all about understanding the different financing options that you have with reducing your upfront costs. So being able to set the terms up front where you can ensure that you're maximizing the returns for yourself. And then if you have passive investors in the deal, for your investors as well too, which requires you to maximize your returns. And one of the great ways to maximize your returns is your ability to use leverage. And so being able to bring in debt versus equity into your deals allows you to maximize your return. And so that's one of the things that you have to look at. Where's that trade-off in regards to how much debt you can put down versus how much equity or down payment capital you need to bring to the table. And then also looking long-term with how do you build long-term wealth with just leveraging this financing to go to the next level for your long-term goals. Number one, conventional loans. The number one pro with the conventional loans is usually you're going to have a lower interest rates and you have that long-term stability where you're locked in for 25 or 30-year amortizations. So we're going to kind of go in. We'll talk a little bit, kind of wrap up on the conventional loan options that one of the biggest benefits is, the lower interest rates. But, you have the higher credit requirements. Right now with the conventional loan, you can get away with a 5% down payment, as well as you can use that for up to a 2, 3, or 4 unit property with those. Because traditionally, when you start talking about conventional loans, most people think about 20% down. Some of the other property types. So number 2, FHA loan. I've used the FHA loan on the property that we purchased in Florida as a primary residence. It was only 3.5% down payment. It's easier for beginners, that first property. The only thing, the downside with that is you are going to be on the hook to pay your private mortgage insurance, your PMI, for that type of property. But it allows you to get into the deal. One of the things that's not precluded from that, we were able to buy a HUD foreclosure using the FHA loan. And most times with the HUD foreclosures and a lot of times even with the bank foreclosures, that they have a set aside period for primary residence individuals where you can buy the property if you're going to live in it, and then they'll wait maybe 2 weeks before they open it up to investors to come in and buy those properties. The downside with FHA is limited to owner-occupied properties. One of the reasons that I like to talk about some of these conventional products is because you can start by house hacking, using your VA loan, buying multiple units, live in one unit for 1 year, then transition into a rental property. We talked about those different strategies that you can leverage, as well as being able to rent out by the bedroom, by the basement, rent your pool. There's multiple ways you can generate income from a property that traditionally where you're only limited to a long-term rental. But now you have a lot of different options, and being able to leverage these different loan products as a primary residence allows you to get in for a lower down payment, live in it for a short amount of time, force appreciation if you're going to do improvements, and then you can rent it out or you can sell it and then, move on to the next project. The VA loan, we talked a little bit about that. No down payment for eligible veterans. Of course, you have to be a veteran in order to use this product, so it's not for everyone, but it's a tremendous opportunity for service members and separated service members in order to build wealth and get into real estate and get into a property. Because one of the great things that I didn't know when I first came into the military, that you can buy multi-units with your VA loan. You can buy up to a 4-unit property. And I think we got 2 weeks, but Jahil is going to come on, and he just recently this year bought a 4-unit over, I think it was a $1.15 million 4-unit property, no money down, in Chattanooga, Tennessee. He's a Army veteran, and he was able to buy this property. Each unit is 3-bedroom, 2 baths with a 1-car garage. It was built in 2023, and he's bringing in over $2,000 per month rent from the 3 units, and then he's living in the 4th unit. And and he has enough land to build 6 more units on the property. So it was a crazy deal where he only had to pay his closing costs, and it was no money down to get in that type of deal. And so that's the power with these different loan products, that how you can build wealth with finding the right asset to buy. Looking at hard money loans, start to get more into the investor space with the loan option. Hard money loans are usually short-term bridge loans. They have quick approval. They have flexible terms. You can get a deal done as little as 2 weeks. I've seen them get done as fast as 7 days. That some hard money lenders have a appraisal requirement, some do not. One of the big things is having the upfront relationship with your hard money lender upfront, where you can understand the terms. They can run your credit, get everything approved with you. A lot of times your credit doesn't have to be perfect, but you need to go through and they really looking at the property itself and want to underwrite the property, and understanding that, some are fine with you not having any upfront experience. Some may want you to have a little bit of experience before with using hard money loans or doing the type of projects that you're doing. But the big thing is having the conversations up front, understanding what their requirements are. So you have this loan in your back pocket and have the approval with the company before you need it, before you get the project under contract. So now everything is streamlined. They're just underwriting the deal. They're already comfortable with you, your experience level, and everything else in regards to being able to get the deal done. Usually the downside with it is higher interest rates and a short repayment period. Whereas that most of these loans, you could be anywhere from 6 months to a 12-month term. I've had hard money loans go all the way out to 18 months for like a multifamily project. And the rates are usually higher, but we underwrite and understand what the requirements are up front. Whereas that we can make sure that we raise enough money on the front end, or we have a business plan that we're able to bring units online fast enough that are going to start paying down the loan, and having that information up front just allows us to leverage the product and be able to still get into the deal despite the higher interest rate, but making sure that we have a sound plan that closes with a conservative time frame. Whereas if you think it's going to be 6 months, make sure you have enough reserves for 9 months and have a plan if you had to, how you could get to 12 months. And so just being able to go up front, have those plans, and be able to make sure that your business plan closes, that hard money loans are a great way to get started. The first fix and flip project that we were able to do, we leveraged a hard money loan from a local lender. He had, the terms were definitely a little bit more on the aggressive side in regards to the lender. He charged a flat 10% fee for the money, which, unfortunately it worked out for him. It worked out really well. He was able to make $23,000. The loan amount was $230K on the deal. Whether we had the money for 2 days or we had it for 364 days, he was making $23,000 on his money. And of course, we only used the money, I think it was a little bit under 6 months for that first loan. But the thing is, it was still profitable. It was our first deal. He was taking a lot of risk on someone who had never fixed to flip the property before in that market. And, and so it's a kind of a give. And so when you start talking about interest rates, that the big sticker with the interest rates is tied to the level of risk with the project. And so that's why, a home that you're going to live in, you got a job, that you got good credit, and they underwrite, they can give you a low risk 6%, 7% in this market today versus a bridge loan where it's going to be 15%, just because they're charging a higher premium or interest rate. because it's more risk involved because you're going in and making improvements. You got contractors coming in. Somebody can fall and get hurt. You could get sued, or you can go in and you don't have experience and mess up the project, or you can go in, anything can happen. And so that's why they charge that higher interest rate. But with that, you can plan for it and make sure that you're in a good position because your business plan and you've underwritten conservatively where you can make sure that you're successful in the long run. Creative financing, my best, I would say, option where is that, I bought a 24 unit, 20 unit property, 100% owner financing with it. So the flexible terms, it was a 3-year note where we had no money down upfront. And we're talking about apartment complex. I bought a duplex before with seller financing. You have some subject to where you take over the existing mortgage, and you just pay your closing costs, and you may pay them some equity on the back end, or just depending on the situation. And so there's a lot of different ways you can do this. You can bring in private investors that you can get promissory notes. You can raise money and give investors equity in the deals, depending if it's a big enough deal with enough equity to go around that you can do that. But you're pretty much limited to the creativity that you had on how you can pay individuals and create win-win situations, whether it's with the seller, it's with other investors, or it's with a private equity fund, or if it's with, even using like your own retirement account on how you can do it. But the thing is, it requires negotiation skills. And I would add in here too, it requires knowledge. It requires knowledge of how you can do deals, because if you don't know that these deals and you can package things certain ways, then you'll never do it if you don't know that it exists. And so it does require you to do your due diligence. But I would argue that you're going to do your due diligence with any of these strategies with that. But at the same time, you got to know what it is that you're doing. One of the great creative financing deals that I love is your self-directed IRAs. That everyone, if you're working for corporate America or for any company, you're going to have some type of corporate sponsored retirement account, usually, whether it's a 401k or individual retirement account. But the self-directed IRAs are they're sanctioned by IRS, just like the normal 401k employer provided retirement accounts. But the thing is, you're limited by the employers because usually they have some manager that's managing it, and you have just a subset of limited investment options that you can invest in with your money. And so when you look at it with self-directed IRAs, it gives you the option to invest in real estate. You can invest in the real estate paper, so you can become the bank, whether it's you're investing in mortgages and notes, private placements when you start talking about like syndications and like large apartment complexes. You can even invest in precious metals, foreign currency, futures trading, crypto, all that you can invest in your self-directed IRA. And the thing is that most people haven't heard about it just because there's not a lot of options provided by the actual employers. But you go in and look at IRS regulations that allows you to invest in a much broader range of investments. But guess what? It's a lot harder if everyone was out there buying real estate with their IRAs for the custodians to be able to service those for your employers. But the thing is that the self-directed IRA is a fairly untouched market, whereas that less than 4% of accounts right now are self-directed. And if you have a rollover account where you work for a previous employer and now you moved on to another employer, you can't make contributions to that retirement account, you can take that one account, or you can take multiple. If I know a lot of IT professionals and they move around quite a bit, but you can take all those different dormant retirement accounts, and you can roll them all over into one self-directed IRA. And now you can go buy investment properties with your IRA. That there are lending institutions out here that lend money to your retirement account, where you can put the down payment money from your retirement account and they'll lend you the other 70, 80% to purchase the property. And now just the cash flow, the rental income, it all goes into your retirement account instead of your own bank account for you to build wealth that way. And so just a lot of opportunities out here. And so with this one, we're going to play. Here's one of our clients, Chandria, that was sharing her experience with using the self-directed IRA. Let me go. I'm going to add this with sound. Click right here, share sound. And we're going to share the screen. Boom.
It's been a true blessing. But guess what the bigger blessing is? We got one of our clients here that we work with in Atlanta that's a family friend and has been crushing it with her self-directed IRA. And so what better opportunity to talk to her right now, just kind of share some of the deals that she's been doing and just that whole process that she's been going through here with building wealth with her self-directed IRA and buying real estate assets. Miss Chandria Poole.
Hey everybody.
So how's that process been? Coming from corporate America and doing everything that you've been doing, with your day job, but how did you find time to kind of get started as a real estate investor and then going through that process and gaining that experience buying assets with your self-directed IRA?
It was nerve-wracking in the beginning. But the more that I went through the process, I studied in the boot camp. I went through talking to various custodians. I got more and more comfortable with understanding the numbers. And once you kind of understand the numbers, everything else kind of feels like, you're kind of getting your flow. There's a lot of paperwork in the beginning. So that was some things that I have really had to commit to in my free time. Anytime I had downtime at work or anytime I had downtime on the weekends, I was focused on getting the deal done. So ultimately, I feel really good about where I landed.
That's awesome. So tell us a little bit about the deal. So what kind of properties were you looking at, and how is that process going with like getting them ready where you can get tenants in and start bringing in that cash flow?
Yeah, so I started with a single family, and that entry point didn't really make a lot of sense since in this market they were kind of at the same price point as some of the duplexes. But I stumbled upon, while looking at a single family, an estate sale for a duplex, and so price points were right. Everything aligned, and so I got a duplex. I was able to put about 30 grand in it, and immediately started renting it about a month after renovation. So tenants weren't hard to find. Hired a property management company to start, but the custodians that I got, they made things happen really fast. So we were able to close on time within 3 weeks. So everything was a breeze after that.
Awesome. There you have it, guys. It's that simple. Get started, get your IRA, find your custodian, and start finding deals and start building wealth with real estate. Stay tuned for the next.
Yes, no, I love that story with Chandria and just really taking action with leveraging her self-directed IRA to start building wealth. And so it's a phenomenal asset because a lot of times people think they don't realize that retirement account and those funds is a way to tap into resources that you may have in the past thought were not accessible. So the thing is, with one that I want to jump in before we get to kind of the next level of creative financing is just a credit investor. A lot of times we hear about accredited investors. And one of the things, if you check out the book, The Holy Grail of Investing that I told you that Tony Robbins wrote back in February this year, that you will understand the level of investing that a lot of things out here are set aside only for accredited investors. That a lot of times that a lot of the offerings, I did a webinar last night on our offering for our 96 unit portfolio down in Montgomery, Alabama. And but we're offering it up with the 503B exemption. We're able to offer it up to accredited investors and up to 35 non-accredited investors. But the thing is that the designation of accredited investor, you can see here some of the bullet points for those. If you work inside of a fund, it's like your day job. If you have like a Series 7 or the Series 6582 licenses, you'll be considered accredited investor. If you're an individual and you make more than $200,000, or if you're married and file jointly and you make over $300,000 for the 2 most recent years, you'll be considered an accredited investor. If you have a net worth over $5,000 for the assets, you'll be considered a accredited investor. Then also for your net worth being over $1 million here, not including your primary home, then you'll be considered accredited investor. Most recently, Congress rolled out. It was still a little bit of a gray area, but they have a test, that you can take to get approved as an accredited investor. But one of the things that it opens the door for seeing alternative investments, for getting access to investments that have asymmetrical returns. When you start talking about, being able to double your money in 5 years with, 10 to 15, 20% year over year cash flow of returns on your money that traditionally, when you start looking at some of the private equity funds, private credit funds, real estate funds that are out here, that they have these higher, there's a little bit more risk. You have to be judicious and making sure that you get into the right deal, but it allows you to get into private equity, and it should be a portion, not all your money going into alternative investment, but a portion of your portfolio should have some exposure to these type of investments, where it allows you to go to the next level with being able to opportunity to gain those higher returns. So I really want to talk about that at a high level. When we start talking about multifamily commercial deals, we talked a little bit about last week with DK that walked through his experience with Just For Us, the commercial side with the triple net leases, with the retail buildings, that traditionally you will see these $1 million plus buildings purchased as a syndication. Whereas that with the syndication that is focused on a single property or a single asset, the returns are based on the performance of the property itself. You can see new construction where you're seeing a development for like 100+ unit multifamily, or it could be a 10 unit multifamily. Or you can have value add projects where you're buying an existing complex and you're going to go in and renovate the building, renovate the units, and increase the rents. And so usually you're going to have a manager that has the business model that's going to have the project and the target returns. The manager raises the capital from passive investors right before acquiring the property. Or, if you're doing like a deal where you're recapitalizing the project, you had the project for a couple of years, you're going to raise another round of capital to finish like phase 2 or phase 3 of the renovations. And usually the manager is going to be compensated based on performance of the actual asset. And a lot of times you'll see preferred returns, like with the Montgomery project that we're offering a 7% preferred return plus equity. And so when you see the manager member splits, it's just kind of how that compensation after you do the preferred return, it's like all the excess disposable cash that's left over. How are you going to split that between the investors? And usually that's how the syndication is managed and modeled. And usually, you have some that are looking to own long term, where they have a refinance milestone, pay back investors, and then they continue to own in the future. Or, it may have a 5-year term where it's like, hey, we're going to implement the business plan. We're going to maximize the profit for this asset, and then we're going to sell in year 5. And we may reserve another 12 to 18 months to, if we kind of fall in the middle of a recession, it's not a good time to sell, where we may delay the sale of the asset to the right time and to maximize the gains and profit for all the members. And so usually, that's what you kind of see with syndication. One of the big things that I wanted to, like when we started talking about alternative investments, like it's just not like everybody on Wall Street. Like one of the things that you see here now is a lot of celebrities are getting to the private equity space. For instance, here, Kim Kardashian, she launched a couple of years ago a private equity firm, becoming the latest celeb to enter the investment industry. And one of the things with this, what it allows you to do is align yourself with different products. Can you think about Kim Kardashian? Like here with Turn with Skim, she turned this company into a $4 billion company just with her reach on social media, being able to have a cosmetic product that she can push to her followers and everything that she can do from a marketing and advertising standpoint. And now she's able to invest as a passive investor with this private equity fund. They bring them money, marketing, her name, image, likeness, and can amplify the returns and take this company that now she's a vested partner in, take it to the next level to build wealth for her, but also build wealth for the founder or whoever, the CEO is of the company, and all the other investors that invest up front with it. And so with this, where her Scott Partners is her new private equity firm that she has. And so you're seeing a lot of these evaluations on how, I think it was her sibling, was it Kylie Jenner, that, just recently crossed over $1 billion for her net worth. That now you start seeing them being able to work with private equity to bring capital into these deals, raise capital for these products that they're able to turn a nice return. But then also you have athletes as well too. Serena Williams, she's a managing partner for her private equity not her venture capitalist firm, the same thing. We're looking to bring in and invest in companies, bring her name, image, and likeness to the brand, to certain products, but then also being able to raise capital for these efforts in order to invest and continue to grow wealth. And so one of the things with the fund model, that when you start talking about like the syndication is traditionally focused only on just one single asset. But when you start talking about a fund that is really focused on a group of properties, whereas that, you focus on maybe a single family or self-storage or multifamily or maybe retail, but usually it's going to have a focus on one or two asset classes. As like with the syndication, returns are going to be based on the performance across all properties. But now you're able to bring in a level of diversification for the portfolio, because now you just don't have an asset in Montgomery, Alabama, but maybe you have an asset in Atlanta, you have an asset in Nashville, Salt Lake City, Phoenix, Arizona. And now you have multiple assets that now you're diversified across different geographical areas, but then also you're diversified across different operators inside the portfolio. The manager has the business model tied to the fund where you're going to deliver a certain number of assets over a time period. So you may raise $10 million. Well, in our case, my goal next year is to raise $10 million for a line of capital for our fund, raise $10 million, buy $20 million worth of real estate over an 18-month period, go through, execute the business model, take that $20 million of real estate purchase and turn it into $35 million in assets over the next 5 to 7 years, and then liquidate and sell those assets and do that. And so that process, it requires the manager to go raise capital all at once, usually up front, and then go through. And on the back end, the manager is compensated from a combination of managing the fund, by the performance of the fund, and then for the individual assets at the sale on the back end. And so the fund is just another way where you can group more capital up front, and it allows you to, one, get better deals where you can pay cash, or you can come in with more buying power that allows you to negotiate better deals, as well as maximize the returns from the fund in the long term. Usually what you're going to see with these are private placement memorandum that just gives you an overall comprehensive overview of the investment offering itself. It gives you the executive summary of all the high-level offering, the terms, whether it's going to be that preferred return, how much equity ownership that you're going to have, what's the time horizon to execute the business plan, who's in management, what are some of the key terms offered included. You're going to look at the manager compensation, the distribution, that's going to be paid out quarterly, annually. Are they expecting to have a return the first year, maybe starting the second year? What are the qualifications? We talked about it. Is it only for accredited investors, or can you have some sophisticated investors in there as well too? What are the use of the proceeds? You're raising the capital. What are the use cases for the capital as well? But we know with real estate, there's always risk involved. So understanding those risk factors, with the property, is it a high risk value add? Is it high risk new development? Is the value add where we're going in and we have half the units were burnt to the ground and we have to rebuild up completely? That's going to be a lot more risk compared to something that's only maybe a property that's only 10 years old and you just need to go in and update flooring and paint. Are there any conflicts of interest? With various conflicts of interest between maybe affiliate companies and the manager and how they're being compensated. So all that's going to be documented in the private placement memorandum, or the PPM. Then next, you're going to have the operating agreement. So basically, the operating agreement is just how is business going to be executed for the LLC, the financials, the functional decisions, the rules, regulations, and provisions that are going to guide the day-to-day operations for the LLC. What's the formation and purpose on why the LLC was created? Who are the partners in the deals? How are distributions going to be paid out from the cash flow? What are the duties and rights of the managers and members? And it gives us kind of a summary roll-up of, hey, these are the do's and don'ts. This is what you are on the hook to provide. And then once the LLC is being closed out, what does that look like? How can members transfer shares? How can members assign their benefits or assign their shares or units to someone else? And how do you, at the end of the day, how do you dissolve the LLC once all the assets have been sold, liquidated, and all the profit has been paid out? What does that process look like? And then lastly, you bind all of this once your investors review the PPM, they review the operating agreement. They say, hey, yep, I'm good to go. I want to invest $100,000 in this effort. Then it goes through and the subscription agreement just kind of lays out those instructions for their investors. It outlines the requirements on to participate, whether they're accredited or not. And it gives them direction on where to send the funds once they've signed and executed the agreement. And then also the manager countersigns, whereas that the investor contribution has been accepted by the manager and the documentation is all signed and kind of kept there for long-term historical references. But the big thing with all this is you got to know your numbers. You got to know your numbers. You got to go through the process of underwriting your deals, understanding the financing terms, and now bringing it all together, understand how can we take this project from where it is today over where there's 6 months, a year, 2, 3, 4, 5 years, and position it to be worth another higher amount for the appreciating value long term, and force it, whether you're forcing that appreciation or you're just holding long term and understanding how are you going to be profitable in the deal. So going through understanding one from your personal perspective or your business perspective, what is your budget? How much are you looking to borrow? What is the capacity that you can borrow? Understanding the access that you have to income and credit and debt to income ratio. But the big thing with it, when we start talking about access to credit, capital, your debt to income ratio, the thing is you can partner for your weaknesses. If you don't have good credit, if you don't have a lot of capital, if you don't have that high paying job with the income coming in, find someone who does. That is the whole being resourceful is not about you having all the resources and having everything that you need in order to be successful with real estate investing, but it's being able to find the right people, getting out here networking and creating win-win opportunities. The second one is exploring your options. Find the different lenders out there. I have a private equity fund out of Austin, Texas that loves to lend to veterans, and they primarily fund most of my deals. But guess what? I have credit unions that we work with in the local areas where we have projects. They're a great resource for long-term relationships, as well as looking at other mortgage brokers that have a Rolodex of different lenders that they work through, where one lender may not be able to get the deal done. You'll have another lender that can help you get it done. And being also always being able to offer multiple offer prices and seller financing, and being able to present a seller financing option to your sellers is always great. And just being able to show them the win-win opportunity that they have by them becoming the bank and owner financing the deal for you, with them being able to save on their taxes, produce a steady stream of income long-term, and it just creates a win-win opportunity. And just being able to go through understanding the different terms, the rates, and requirements allows you to compare your different options and find the best option for your deal to be successful, that gives you that flexibility and just sets you up for long-term success. Documentation. We talked about that, in regards to, hey, you want to, so a lot of times when you submit your offers, they're going to ask for the proof of income, credit reports, your financial history. They may ask for like a bio just to see the previous deals that you've done. But guess what? With all these things, make sure that you understand that you can partner, that you can find others that you can have on your team, where now you can bring the totality of the group together, where it's not all these requirements falling on just you by yourself. Because there's, like my mom always said, there's multiple ways to skin a cat. And so the thing is, you got to get comfortable being uncomfortable and thinking outside the box on how you can be successful and how you can get to yes. And then really just gathering all the documents to speed up the process, where you never want to be in a position where your lender is waiting for you, but you always want to understand up front what are those requirements, building that relationship up front, understanding their application process, what documents are they going to require. So as soon as you get that deal, you can get it submitted with everything that they need, and they can get the underwriting process started soon. And then asking the right question. You want to understand the loan terms, the conditions of the loan, and really having that sit down before you have a deal with your mortgage broker or with the lender at the credit union or with the fund manager, just to understand, hey, what are they looking for when they're underwriting the deals? What type of deals do they like to fund? And then from now, you can go through and make sure that your deals that you're out here negotiating align with the lending institution, the bank, or the fund or the private investors that are looking to invest in your deals, making sure that you have that alignment with everyone's goals. Because at the end of the day, you're going to have to create win-win situations for everyone, for yourself, for the seller, for the bank, where it's the credit union, the mortgage broker, the fund, the private investor, or whoever it is. That the more that you understand what they're incentivized for, what are their goals, that now you can align your loan terms and conditions to kind of meet everyone's need, or for that preferred lender for that deal to meet their need. And then don't hesitate to negotiate or clarify details. Like if you don't ask, you'll never get yes. You'll never get no. And so the thing is, like, the only thing they can say is yes or no. If you don't ask for the seller financing deal, then you're never going to get it. And so the more familiar that you get with the knowledge of underwriting the deals and the confidence that you have in your numbers, it allows you to be that much more confident when you're going into negotiations as well, too. Don't overextend yourself. Make sure when you're budgeting for your properties that your monthly payment, that it fits within your budget. Look for those hidden costs, whether it's closing fees, the interest rates, the insurance. You want to have all that stuff up front as you're going through with your initial underwriting, where you're not surprised on the back end. With the big one, especially when we look at like our Florida properties and really across the board, all properties, just the insurance numbers, because insurance has been one that's tripped up a lot of people. Avoid having to rush. Take time to compare options and understand the terms up front, whereas that you can go in with eyes wide open and you're not surprised. As we wrap up week 4, identify 3 financing options that kind of fit your goals. Whether it's, you feel comfortable out here raising capital, maybe you're looking at maybe going to like a house hack or leveraging investment as a primary residence, where you're using like the FHA or VA loan for a property, or, maybe looking at it like, hey, maybe hard money, I'm going to raise some money, or maybe I may try to find like a fund that I can look at doing, or maybe you're looking on the multifamily route where it's like, hey, I'm going to do a syndication where I'm going to raise the capital that way. And just understand, hey, where's your reach? How much capacity do you have for borrowing? And understanding, hey, what's your potential budget for your first deal? Whereas that, you don't want to go and get a $10 million deal where you have to raise $2.5 million if you only feel like you have the capacity to raise $250,000. And so you want to make sure that your goals and your strategy align with your capacity and capabilities as well, too. Or hire someone or bring in someone, a partner or the team, in order to get to that level where you want to be at. And then make sure that you kind of share the findings in your group. It's always good. I love seeing the feedback and the videos with you guys executing in the group and just sharing and motivate, because you don't realize who you're motivating by helping others get out of their comfort zone, by sharing your goals, sharing your experience, and just being able to find that alignment. So that is it for this week. We got a few minutes left. I'm going to open up the floor for questions. For anything that we've covered the last few weeks, from the mindset, the different strategies, the financing, all of that is open game.
Johnny, I have a question. It's about syndication. So when you invest in a project, is it like outlined what the expectations are for an investor? Say a person puts in 100,000 or 200,000. Is that outlined in the operating agreement in terms of any additional expectations for that investment?
No, great question. Yep. So normally it's going to be in the private placement memorandum. That's going to kind of lay out all the information, and I'll bring that up just because I've been working on ours. We have ours here. There we go. But yeah, and usually like with the private placement memorandum, it's going to be maybe 30, 40 pages, and it goes through a lot of the details in regards to everything that's happening with the actual investment itself. And so what I'll do, I'll actually kind of go and we'll just look at the table of contents real quick for the PPM and just kind of show everybody, because that's a good question that a lot of people would want to see. And so it just kind of goes through and it lays out, hey, like what's the total offering, what is the minimum offering. But then after that, you kind of go into a lot of different areas where you have the summary of what that looks like, and the time frame, how much money they're raising over time. Can they extend it 3 months? And it just goes through, it talks about the exemptions with the securities with the SEC and lays that out. And just kind of methodically, it's a lot of lawyers speak, but you go through, it talks about the company and what's the role of the company. In this case, the role of the company is buying 19.99% ownership in this other LLC that owns this multifamily property. And it talks about the offering itself, but then it goes into the use case or use of the proceeds, the authorizations, what you can and can't do with the units. And then you just talks about who can invest, how you can subscribe, the summary of the offering, risk related with forward-looking statements, risk factors that you need to look at, management, estimated use of the proceeds, the business description of the company, description of the units, operating agreement. Then you just talk about, hey, how's the manager being compensated? When are they issuing reports? And then you see there the kind of the operating agreement is usually an attachment, the articles of organization for the LLC, and then just the exhibit of just the fees and the management compensation. So all that kind of is included, but it really paints the picture of what's going on with the investment. Whereas that one, now you as an investor understand all the risk that's associated with it, how individuals being paid, what is the business plan for the company, what are they supposed to be doing with the money, and everything that's laid out with it. Whereas that now there's no rocks unturned, where you have a clear picture of everything that you're signing up for with the investment.
Thank you for explaining that. I appreciate it. Thank you.
Yeah, no, that was a great question.
I have a question as well.
Hey, Michael.
Hey, so I want to know more about because you were talking about focus, know what you bring to the table, and when you're looking for a partnership, know what you're looking for. How exactly do we go about structuring that per se? Like having that conversation of, this is what I bring, this is what I need you to bring. I don't want to push it in too fast or too early in the conversation, but I also don't want to drag it out. So I don't really know what that looks like.
Yeah, no, great question. That it doesn't have to be something formal. It's like, just as you're going through, it's like, hey, I'm a really good communicator, or, and really thinking about what you could do for free that you wouldn't have to get paid to do. If you're really good at math, then you may be inclined to underwrite. If you're an extrovert, you are really outgoing. You have a bunch of high net worth individual friends, or you like just going to seminars and conferences, meeting new people, then you may be a capital raiser, looking to raise money for your deals. Or, like, hey, you're really organized, you may be one that's kind of looking on the asset management side, where you want to coordinate and manage the renovation projects. Or, you may be one that wants to do like the marketing, find the deals, networking with brokers. So it's really like figuring out what's your superpower, what you really love doing, but then also finding out what you don't like doing. And then, and just from like events like this, with the webinars, different Facebook groups, getting out to in-person events, you hear other people that, hey, you find somebody that's really passionate about it, but they love to underwrite deals. They're really good at math, or they're really good at raising money. Excuse me. So, and then, it just kind of, it's organic, that it doesn't have to be forced, that sometimes you're lying. And I'll tell you that a lot of times that sometimes the partnerships, they outgrow themselves, where, sometimes people's emphasis and priorities in life change over time. And that's okay. But the thing is like really understanding what are you doing. And I think having those agreements, especially when you find the first deal, when you find a property, having those agreements documented, oh, hey, this is how we're being compensated. Like, this is what you're on the hook for to deliver. And then having a backup plan, because guess what? If it's three of you guys as manager, then it gets down to one. Like, the limited partners don't care about, hey, so-and-so kind of walked out on it. It's like, hey, you guys signed up to manage and take this deal on and see it through. And so I think it's just really an organic conversation and building time. And so you'll kind of find those people that align with your values, with your ethics, and with your mission. And when you find those individuals, you kind of make it, you figure out what works. But I think at the end of the day, even when you find those individuals, making sure that you document it in the operating agreement up front, when everything's good and hunky-dory and it's all rainbows and unicorns, document, hey, this is how things are going to happen. This is how the management works and all those things. So if something happens, then, you can lean on the operating agreement to keep things moving along.
Thank you. That makes sense.
Cool. No, great questions.
John, this is Kevin. I have a question.
Hey, Kevin.
Hey, regarding that self-directed IRA, that's something I've never heard of. So, find out more information on how that works. Do you recommend I reach out to? So, in my case, it would be from a previous employer, and this is I see this as the Lord's timing, because I was getting ready to roll it over into my TSP. But
okay.
Instead of doing that, I can do it as self-directed. But what is the step? Do I need to contact that company, Lincoln, or how does that work?
Oh, great question. So there's a couple different custodians. Equity Trust is one. Advanta IRA is another one. I met one that has some really cool terms where they waive a lot of their fees for veterans at a conference with the American IRA. So some different options. I work primarily with Corey. I can give you Corey's information with Advanta. They're really good. I know a couple of people that invest with us that leverage Advanta IRA.
Okay, great.
So yeah, and it's really straightforward. Like, they help you with all that. So you kind of have a one-on-one session with them. They can work with the previous employee or your previous custodian and just help that process where they can roll it over directly to them. There's no gap period, so you don't have to worry about paying any fees. And and they can help you get all that set up in a short amount of time.
Perfect. Thanks. I appreciate it.
Yep. Yeah, no, I'll shoot that over your way. And actually, I'll drop it for everyone so you can have it inside the Facebook group so everybody can have Corey's information. I see one message here in the chat. Is replay. Yep. So the replay sessions are available. Yep. So each week the replay sessions will be there in the Facebook group. You can find them. I think there's one post that has like the last 3 weeks all together. So yep, definitely you can find those in the Facebook group for those. Any other questions? So digging in on the finance. So definitely take a look at some of the different options. And I love credit unions. I can't say that enough. If you're looking like in your local area, then definitely consider, building a relationship with a local credit union, especially one that does like commercial lending, where they can lend money to your LLCs for your projects. So that'll definitely be worthwhile building those relationships. And I know one of the things too that we're working on is the business credit and bringing in. I didn't talk a lot about that, but bringing in the business credit. And there's a couple different sources. I got one that I'm in the process of trying. We'll try out in January, just see how they execute before I can recommend them. But yeah, business credit is another one that you can leverage as for financing as well too. Okay. Going once, going twice.
Johnny, I have one quick question. Can you hear me?
Yeah, I got you.
Hey, how do I sign up for the seminar in Montgomery and Birmingham?
Yeah, shoot me an email and I'll send you the link where you can sign up.
Okay.
Yep, no, great question. Yeah, and so we are doing a 2-day mastermind event so day one is going to be in Birmingham, and we're going to go to the Alabama Commercial Real Estate Conference, the annual conference that the University of Alabama puts on. And they bring all the developers, property management companies, local lenders, co-stars there. Anyone within commercial real estate. They usually bring over the Atlanta Fed chairman for the Atlanta Federal Reserve that comes on, talks about the market. And that was a really good day. And then day two, we're gonna kind of take a 15 passenger bus down to or van rather to Montgomery to go down to my complex there. And we're going to walk the property, do some Q&A, and then we're going to look at have lunch, have dinner there in Montgomery. In the afternoon, we're going to do some hot seat sessions to kind of help take people to the next level with some of the real estate questions that or challenges they have in their business, what they're doing. I hadn't talked to them yet; they don't know it, but I'm gonna look at hosting it at my property management, their firm downtown Montgomery, and have them share some things on the management side as well, and and kind of talk through our 2025 business plan and what we're doing for the complex there with the 96 units, and just really going through that process of asset management when it comes to multifamily. So, yeah, if anybody's interested in that, definitely shoot me an email. I think we're going to shoot for like 15 slots. If we have enough participation, if not, then we'll cap it off at like 7 or 8 and just get one table. So, but yeah, with that, any other questions? If not, you guys have a great evening, and need anything, just let me know in the Facebook group. And I think she just dropped thanks, Faye. Faye just dropped the link right there, Kevin, for the 2-day event there in February. All right. Any questions come up? Look forward to seeing the chat in the conversation going on in the Facebook group. And we'll see you guys next Monday as well, too, versus New Year's Eve. So you guys enjoy.
Thanks, Johnny.
Yep. Have a good one.
Thanks
Good to see you, Sean.
Merry Christmas.
All right, Kevin. Yeah. Merry Christmas to you as well.